They're controlling. Okay. Welcome to the May 2017 meeting of the Finance Committee. It's a nice day in New York City. First up is the adoption of the meeting minutes from the April Finance Committee meeting. It's only Charlie and I think, today. Can I get a motion, Charlie? Thank you. I'll second that. All in favor? Aye.
Aye.
Aye. Any opposed? Hearing none, the meeting minutes are adopted. And we'll be addressing two matters today. First up, behind tab 4, is a small offering from New York State Sales Tax Revenue Program and Personal Income Tax Revenue Bond Program. That's going to be presented by, I can't see who's up there. Who's presenting, Portia?
So, Jerry, I'm presenting now. Andy's tied up on a
Portia's presenting. And I see that we have Tim Wood there from the Division of Budget. Thank you. And
Tom
also,
Wood.
Is that Adrian there?
Yep.
How you doing?
Tom Wood. Sorry, Tom.
No problem.
Thank you. Portia?
Yep. Thank you, Mr. Chairman. So the Finance Committee is being asked to recommend to the full board the authorization of the use of two alternate state-supported debt programs for refunding and to fund various new money needs. The two programs are the Sales Tax Revenue Bond Program and the Personal Income Tax Revenue Bond Program. As you know, the mechanics of the two programs are very similar. The major difference is really the stream of revenue that's used to secure the bonds, either personal income tax revenues or sales tax revenues. The Finance Committee is being asked to recommend to the full board issuance of multiple series of tax-exempt and taxable, fixed and or variable rate bonds issued at one or more times, with terms of 30 years to be sold on either a competitive or negotiated basis or a combination of both. The proposed bonds can be issued under either program or through both programs, but with the combined issuance not to exceed $3 billion. I would note that the term of the refunding bonds will not exceed the term of the bonds to be refunded, considered in the aggregate. As we noted last month, we've asked for flexibility previously to issue bonds under one program or the other, either sales tax or PIT. As we did last month, we're also asking for the flexibility to issue under both programs. Again, under any circumstances, the amount to be issued will not exceed $3 billion. As you know, so we have this $3 billion refunded in new money authorization, and as you all recall, the Finance Committee and the board considered last month a $2 billion new money authorization. We expect that we will undertake an approximately $2 billion refunding under the PIT program, and it's expected that $3 million in new money authorization, as between this authorization and the April authorization, will take place in one PIT deal and one sales tax deal. So we're really expecting to see 3 transactions, one PIT new money, one sales tax new money, and one PIT refunding. And this is consistent with our issuance history over the past few years. Just as a matter of reference, last year, DASNY issued approximately $3 billion of debt on behalf of the state under these two programs. In 2015, we issued approximately $4.7 billion under those two programs. The difference being actually that in 2015, there was an additional refunding that we did on the state's behalf for some transportation bonds. The state's enacted budget calls for new money debt issuance totaling approximately $7 billion, $6 billion of which would be funded through the PIT or sales tax programs. As you know, this transaction qualifies as a single approval because it's a new money transaction, refunding for one of the authority's public programs, which are already in the authority's portfolio, for which bonds are issued pursuant to a supplemental resolution and a previously adopted general resolution. Just a little bit more information on the purposes. The refunding plan includes the refunding of certain bonds issued under various programs, including the personal income tax program, the state service contract program, the mental health program, and other state-supported debt programs. The majority of the refunding candidates are bonds that were issued by DASNY. It's about $1.5 billion of the $1.8 billion. The remaining refunding candidates, a little bit more than $300 million, were issued either by the Environmental Facilities Corporation or the Thruway Authority. All the refunding candidates meet DOD's refunding criteria. The final bonds of the refunding bonds will not exceed the maturity of the bonds being refunded, again considered in the aggregate. Based on current market conditions, the proposed refunding generates gross debt service savings of about $172.8 million, net present value savings of about $165.8 million. This results in a net present value benefit of approximately 10.2% of the bonds being funded. On the new money side, the bonds are being issued for various new money purposes for capital projects under a number of different programs, including state and voluntary facilities for various mental health agencies. That would be the Office of Mental Health, the Office of Persons with Developmental Disabilities, and the Office of Alcoholism and Substance Abuse Services. In addition, there are certain capital projects that will be funded for voluntary agencies that also have the benefit of low-income housing tax credits. There are also various capital projects undertaken through the Consolidated Local Street and Highway Improvement Program, CHIPS. There are also various transportation initiatives under New York Works, and various education programs, including Excel, ECAP, library facilities, and longitudinal data systems. With respect to security, as you know, if the bonds are issued on the sales tax revenue bond program, the bonds will be paid by semi-annual payments made pursuant to a financing agreement between DASNY and the state. The bonds will be secured by a set-aside of 1 cent, or approximately 25% of the state's 4% sales tax, to be collected, which is collected pursuant to statute and deposited into the sales tax revenue bond fund. Current debt service coverage for all sales tax debt is 5 times. If the bonds are issued under the personal income tax revenue bond program, again, the bonds would be paid by semi-annual payments made pursuant to a financing agreement between DASNY and the state. And in that case, the bonds are secured by a set-aside of 25% of personal income tax revenues, again, collected pursuant to statute and deposited in the revenue bond tax fund. Current debt service coverage for all outstanding PIT debt across all issuers is 3.5 times. And as you'll recall, the rating on both of these programs is AA1, AAA, AA Plus by Moody's, Standard & Poor's, and Fitch, respectively. Mr. Chairman, at this time, Tom Wood has joined us from the Division of Budget. And so, we'd like to ask Tom to provide some additional information regarding this authorization.
Please, thank you. Thank you, Portia, and thank you, Tom.
Very good, thank you. Well, we appreciate the opportunity to speak to the Finance Committee today. We know Portia does an excellent job on briefing boards on the state's bond transactions, so we thought we would just touch on some policy issues that have driven, in part, a lot of these early approvals that you're seeing of the state. So we'd walk through that. We'd also talk a little bit about the state's debt burden to give you comfort that these debt issuances are part of a plan, and they do fit within the context of an affordable plan for the state. So certainly given the magnitude, we understand the reason to discuss this, and thankfully we're in a position where we think the state's financial position is as good as it's been in probably the last 50 years, and there's a couple of different things I would point to when we make that statement. One is the state's credit rating is currently a AA plus with S&P and Fitch. It's AA1 from Moody's. Those are the highest ratings that the state has seen since 1972, so clearly that's a good position to be in. And then obviously the credits that Portia talked about, both the sales tax revenue bonds that we sell and the PIT revenue bonds that we sell, are all AAA rated credits. So we're pleased to be in a position to sell obviously credit-worthy bonds. In terms of, I thought maybe the best place to start was just to give you some sense on why are we asking for such large approvals in April and May? Clearly, they're more than you've typically seen, and I guess I would focus on a couple of points. One is the state, working with Portia, made a conscious decision to accelerate its approvals to earlier in the state fiscal year. The state fiscal year runs from April 1st through March 31st. In past years, we've typically sought approvals on a just-in-time basis. So if the bond sale was going to happen in September, we typically are going to boards in June or July and getting the approvals just before the bond sale happens. This year, we changed it, in part because we did have some challenges away from the Dormitory Authority last year, and that there was a glitch in an approval process. So we're trying to position the state so we don't experience a glitch this time around. So that's the reason for earlier approvals. Secondly, I'd point out that there are some policy decisions that have been made over the years that also will result in higher bond authorization requests earlier in the year. One is the state's consolidated its debt issuers. We've reduced the number of entities that sell bonds on behalf of New York State from about 10 to 3. Those 3 entities include the Dormitory Authority, obviously, as well as the Empire State Development Corp. And then the state comptroller sells bonds for us for the general obligation bond portfolio and the local government assistance corp. Those are the 2 programs they sell for. So the predominant state issuances that fund our capital plan are largely done by DASNY, with ESDC doing some as well. And I guess what I would point out is if you look at the 2 approvals in April and May, you will notice that there are some items on there that we're asking DASNY to finance that they traditionally have not done. So for example, transportation purposes, environmental purposes, those had tended to be done away from the Dormitory Authority. I'm going back probably 5 or 6 years, and now we've asked DASNY to finance some of these. That has changed the dynamics of the approval. So the state's not issuing more debt for these purposes. We're simply consolidating issuances into 3 preferred state debt issuers, the Dormitory Authority being the predominant one. Another reason you're going to see larger approvals is we've also consolidated our bond credits as well. Whereas we used to sell credits for just every different program, for example, SUNY was a different program, CUNY was a different program, mental health was a different program. We've abandoned that model and gone to a consolidated model where we're selling for 2 different credits, but we're selling everything on a consolidated basis. So rather than seeing different amounts for different programs, what you're seeing is highly visible, large approval amounts for either the PIT or the sales tax program. So we just want to make sure we're clear on, we've kind of moved more to a GO type of approach, a general obligation type of approach for sales tax and our PIT, our 2 flagship credits. So we just wanted to make you aware of why you're seeing bigger approvals earlier on in the fiscal year. Now I'd just like to turn your attention for a minute to, well, given the level of issuances being requested, is that affordable for New York State? How do we think about that? And I guess what I would say is over the past 7 years, the state's used a disciplined approach to control and target new borrowings to keep debt service affordable and remain within, the state has a debt limit as well, and stay within that limit. So I thought we would give the board just a couple of different data points to point to give you some confidence that New York State does in fact have an affordable debt profile. The first one I would mention is state-related debt, which is a broad measure of the state's debt outstanding portfolio, has gone down for 4 years in a row. In fiscal 13, 14, 15, 16, and we expect 17, actual total debt outstanding has declined. And I'm just looking, I can provide a slide if people want it, but it's gone down almost $6 billion, from $56 billion to $50 billion over that 5-year window. That's extraordinary. We almost never, I don't think there's a state in the country that's seen that kind of reduction in its debt outstanding over the past 5 years on a percentage or magnitude basis. The second point I would make is another metric that the rating agencies typically look at when they're looking at debt affordability is a measure that's called state debt outstanding as a percentage of personal income. It's an affordability measure on how much debt can you afford relative to your state's personal income. From fiscal 2011 to fiscal 2016, we've seen that decline from 5.9% to 4.5%. And I guess what's remarkable to me about that is this ratio fluctuated between roughly 6% and 9% for probably 30 years. In the last 10 years, we've finally seen it start to decline in the state's favor. It's the best position we've been in decades. So again, that's a very common measure that rating agencies use to try and indicate, does the state have an affordable debt profile? And then finally, just in terms of all this debt, what does it mean? The state's debt service costs have ranged from about $5.6 billion to $6 billion over the last 6 years. So it's a very manageable range right now that we're in from a debt service cost perspective. And given I just mentioned that debt outstanding has come down over 5 years, through the trajectory in debt service cost near term, when you factor out prepayments and those types of things that are used to manage a financial plan, the debt service costs are effectively flat, and probably even declining slightly when you take out, again, some of the prepayments. And then even if you look at the issuances we're asking for, or the approvals we're asking for now, and the issuances that will drive, we still think that the debt service growth trajectory from fiscal 2011 to 2022 is in the range of 2%. And in a budget that's $105 billion, we think it's a very manageable growth rate to cover on the debt service budget side. So that's just to give you some sense on, can we afford it? We certainly in budget think the answer to that question is yes. With regard to the specific request, I know Portia covered a lot of the details. What I would say is that between the $2 billion approval that we asked for in April and the $3 billion request we're asking for in May, it allows us to accomplish two primary objectives that are very important to the state. One is, Portia mentioned the savings that are in the $170, $108 million range. We anticipate doing a $2 billion refunding. Those savings have already been booked in the state budget, so it's critical to us that we execute that sale on a timely basis so that we can realize those savings in the budget. And then secondly, Portia also mentioned that, again, across those two approvals, there's about $3 billion of authorizations to reimburse the state for capital expenses that it makes in the first instance out of the general fund. That's critical to us, the state, because we are naturally concerned about the state's cash flow and its cash position. So as the state spends money for capital projects, it's important that when we request the money from the dormitory authority that it's available to bring back to reimburse the state. Otherwise, it creates a gap. So that's the reason for these two different approvals that we put before you. In terms of why the numbers look a little bit bigger than they do, I think our simple thought is really all we did is accelerate. One approval you would typically see later in the summer or fall really got accelerated into April. And that's why you're seeing a big change this year relative to prior years. Other than that, we think it's pretty much business as usual. So I don't know if there's any questions for the state. We can talk through the mechanics on why do we use different credits or whatever questions you might have.
Well, first, thank you very much, Tom, for that very, very excellent presentation. Very, very informative and very, very useful. I'll ask Charlie, you have any questions? Or John Gardner is also a board member here. Perhaps he has a couple of questions.
I have no question.
John?
Tom, I take it the Division of Budget recommends that we approve this bond issue.
Yes, we do. Maybe I should have led with that.
Thank you.
Thank you, John, for. Anyway, any other questions or concerns?
That was excellent. That was
Yes,
really,
it was really very,
very
very
good.
informative. It's good to know that the state is in a good fiscal standing. So,
Good is an understatement. It's excellent.
we'll go with very good. But thank you. Certainly gives us all a good comfort level, and I'd be happy to recommend that this I'm offering be approved at tomorrow's board meeting, and then we will advise the board of Tom's presentation. Portia, I'm sure, will assist. Charlie, can I get a second?
Second.
Second. All in favor, aye? Any opposed? Hearing none. Thank you very much, and thank you, Adrian, for setting up Tom and bringing him to the Finance Committee meeting.
Thanks to Tom. All thanks to Tom.
Next up is a TELP financing. A little less in the amount, but nonetheless just as important. From the White Plains Hospital Medical Center. Portia, is that you?
Yes, thank you, Mr. Chairman. Behind tab 5 is financing in the amount of $18.2 million on behalf of White Plains Hospital and Medical Center. As you know, so this is a financing in a total amount not to exceed $18.2 million. As you know, it is a policy of the Public Authorities Control Board that financings that exceed $10 million in a calendar year be brought, a 12-month period, be brought before the board and PACB for their approval. There is behind the memo an equipment list which notes the various types of equipment to be financed here, including radiology, surgical, and other equipment. Thank you, Mr. Chairman.
Thank you very much, Portia, and thank you also, Portia, for the presentation on the bond offering. Can I get any questions or any concerns, Charlie?
Just to let you know, department staff has reviewed this TELP proposal, and we find it acceptable.
That was going to be my question, and thank you.
I can make a motion for.
And I'll second that. All in favor, aye. Any opposed? Hearing none. That motion also carries. Unless, Portia, I'm missing something, I think I can conclude today's committee meeting and ask for a motion to adjourn.
So moved.
And I'll second that. All in favor, aye.
Aye.
Any opposed? None. That concludes it. And thank you again, Tom, for that very, very insightful, excellent presentation. We truly appreciate it, and thank you for coming today.
Are we doing this?
Which one?
Cerebral palsy?